So it's really good to be back at another summit, albeit a virtual one. I think you'll all agree that Pinnacle's done an outstanding job getting it together in the circumstances. So really great to be able to introduce our Australian Equity Income Fund. It's a pretty big day for Solaris. We've in our 13th year and only had 2 products launched so far, so we don't exactly flood the market. And indeed, this is our 3rd product. And the launch is very exciting for us, as Matt introduced, because it's a very interesting time to have a go at a product suite that is under a lot of pressure. So we're trying to do it a little bit differently, would be my summary. And further to that, the title hopefully sells the story, which is the old way simply is no longer working. When I say launching the fund, I should clarify that just a little. We have indeed run this fund for 3.5 years with seed money, being both staff and Pinnacle money, and we've achieved both our yield and our capital objectives, our alpha objectives, about which we're very proud. But the same 3 people, and maybe this is indicative of the lack of action up here in Brisbane, but the same 3 people ran a very similar fund in the 2000s for 5 years, myself, Lorana Cito, and my colleague Bernard Machin, for Suncorp. So we're not new to the space, but we are astounded at how much the space has changed over that period, and hence the need to do it in a new way and shed the baggage of the past, which is the theme of the chat. So let's hop into it and have a look. This is a very quick overview. I won't labour the point, but this is our 20-year track record at Solaris, rolling 3-year numbers, and our hallmark is the consistency of the performance. Indeed, we've outperformed in 16 of those 20 years, and we're very cautious about what and when we bring to the market. The core product is the one pictured there, a 20-year track record. The long short fund has been very successfully launched over the last 5 years, and this indeed is our latest, and there won't be another one for some time. But the reason we have that core performance chart is that all 3, or the 2 new strategies, inverted commas, are anchored to core. They're extension products. We don't recruit new teams to run the new product. We stick with core, and the same process, the same people, and the same alignment is therefore replicated across all of our product suite. And indeed, we get to, I don't know what's the word, pinch the IP of core, and indeed, hopefully, and certainly the track record to date is indicative of this, get the consistency of returns that we've enjoyed in the core product. We start with core, we modify it to maximise yield, and interestingly, there's only 4 or 5 stocks in any 12-month period that are actually different from core. So if core wins, the other products win, and we like that all-in approach. So I won't labour that point. If we move to the next slide, excuse me, let's have a look at why we think the old way is no longer working. These are 2 portfolio returns for exactly the same portfolio, and that is the traditional yield sectors of banks, which we put in at an arbitrary 50%, REITs we put in at an arbitrary 40%, and Telstra for the remaining 10%. And it's a fascinating chart. We've got that performance for the last 3 years on the left in the red, and it should be in red because it's been very disappointing. And then that performance of the same portfolio on the right in blue. Now that shows the previous 8 years. So the 8 years of returns of that portfolio to the 30th of June 2017, the exact same portfolio. And interestingly, despite the market difference in the 2 graphs outcomes, the yield was achieved in both cases. So the one on the left, despite having a chronically inadequate outcome, actually achieved its yield objective. The entire delta was in the capital. And this is the oft ignored part of the income fund world, that you need to chase yield irrespective of what the capital outcome is. And of course, the investor doesn't want that. And the investor's been very disappointed, as Matt alluded to, in this space because of it. If I turn around to you and give you 5 to 6% yield, but chew up your capital by 40% in doing it over 5 years, you're going to be very, very unhappy, and rightly so. So what is the solution? Well, we must seek new sources of yield, and I suppose the colloquial way of saying that is shedding the baggage of the old. The old ways no longer work. One must look to more innovative, dare I say creative, unexpected, unlikely candidates to achieve what we think is very achievable, the nirvana of both yield and capital objectives. And we don't think, I was talking to someone earlier in the day who asked whether we preferred yield or capital. I don't think you have to choose. You can be pretty greedy if you ask me. And certainly this fund has achieved that. So let's have a look at a few unlikely candidates and how they've gone. BHP, well, you know, if you had any eye for history, you would be somewhat shocked that this is my first example of a yield generating machine. BHP, former BHP investors and or executives might roll in their working metaphoric graves if they heard that, but the numbers are the numbers. BHP over the last 3 to 4 years has produced 7.7% per annum yield, while also giving a total return of 17.2% per annum. So it has achieved both of these objectives, and indeed has been a very large part of our income portfolio. We liked BHP in the core portfolio, and we liked it even more in the income fund. I mean, you might ask why we didn't own Fortescue. Well, you know, I wish we had have owned every WAC stock and every FANG stock, but we didn't. So, you know, one must be content with what one has in the portfolio, and BHP has made us more than content. I bring up the example because it is so unlikely that Australia's largest miner would be introducing this section of one's income fund presentation, but here it is. And the reason, well, the last resources downturn saw a very large change of behaviour for the large end of town, not so much the small and middle-sized miners, but the large end of town suddenly were shocked into changing their capex behaviours and allocations. And suddenly, in a very uncharacteristic fashion, we saw off-market buybacks, increased payout ratios, special dividends, and all these nice things that an income fund really enjoys coming from the country's biggest miner. So it does not matter. You can't bring stereotypes to the table. You just need to look at which companies are doing what and ignore the past with respect to a stereotypically healthy income fund participant. BHP has been fantastic, and we continue to see it. In fact, has one of the higher yields at the moment in a forecast sense, well above 5% fully franked. So we're not going anywhere with respect to that register. If we move forward, again, a investment bank is probably more likely, it has the word bank in it, but indeed unlikely to be one of two case studies for an income fund. And our whole point is you just need to look beyond the traditional sources, be open-minded and invest in the companies irrespective of their categorisation or their history or what one perceives as a stereotype, and simply invest in those that indeed pay the dividends, and Macquarie does. It's had both, like BHP, a very high average gross yield over that period that you can see in the graph, as well as an excellent average total return. And put simply, growth matters. Macquarie Bank has had close to, I think it's 17, 18% compound EPS growth, CAGR, over the period of time since listing in 1996. And that puts it up there with some of the best growing companies in the country. There's one big difference. The perception of risk sees Macquarie at a mid-teens multiple rather than the 40 times plus, 80 times plus, 100 times plus that we see some of the tech stocks enjoy. And equally, Macquarie pay out a large amount of their profits in yield, and makes it, again, a candidate that we like. Now, it had a profit downgrade earlier in the week, which was fantastic timing for my presentation. I really enjoyed that. And But I reflected on it, and it is like the reason the stock hasn't crashed in response to that is that many stocks are enjoying the luxury of folk looking across the valley. In first half 2021, is that indicative of sustainable earnings? Well, in many cases, the market has said, no, it's not, across the reporting season. Indeed, they said, no, it's not for Macquarie. We can see some real logic in that. Macquarie has 3 or 4 businesses that are cyclical lows, aircraft leasing, the M&A, IPO business, and also organic growth and funds management and the like. Excess capital, very well managed, and a long history of under-promising and over-delivering. So we're very comfortable still with Macquarie Group, both in the core portfolio and particularly for this chat in the income fund, and believe it can, like it has, achieve the twin goals of both capital appreciation and attractive yield. The next group of stocks is a little bit more punchy. I mean, these are stocks that historically have been looked at as zero yield payers. So why am I highlighting them? Well, these are the growth stocks in our portfolio, and as Michael Bell, my colleague, referred to earlier in the week, we're not growth or value. We are a core style neutral manager that does not need to choose between growth and value, and that bet at the moment is largely neutral. But I'm highlighting these because of how well they have done for the capital side of the equation. Each of them has only got about a 2% yield, some a little bit less, some a little bit more. But Appen, for example, has been a 7-fold performer, 700% over the period for 3 years that I'm talking about. Northern Star, a gold company, is 200%. CSL is up 150%. These are the stocks that you can see in front of you that, while also unlikely in their inclusion in an income fund, have anchored the capital growth of this portfolio. And I repeat, one doesn't have to choose in our mind. To reiterate, this is a portfolio that has indeed achieved its yield objectives over the last 3 years, despite having a whole bunch of names that you've seen me refer to as very unlikely candidates. So we'll just double down, if you like, on this very point. The most extreme example of all is Telstra versus CSL. If you were smart enough, on the one hand, to invest in CSL when it listed in the mid-90s, and misfortunate enough to invest in Telstra when it listed a few years later, both companies spun off by the federal government, your first investment in CSL will be up a staggering almost 400-fold. Your second investment in Telstra is down 20%. They both listed, amazingly, with a similar yield. You can see there on the right. But if you had, as I say, kept the investment the whole way, then the current dividend divided by the IPO price, so your purchase yield, if you like, is a little bit under 5% for Telstra and 266% for CSL. So, growth of both capital and yield must be considered. CSL is a stunningly successful yield stock if you bought it at IPO and you haven't changed. So growth really matters. People tend to look at these things in isolation, 1-year windows. And this is the most extreme example of how that can give you a false read. Growth matters, and growth indeed enables a company to provide a very good yield if you're smart enough, as in CSL, to hang on to the position. I don't know too many people who've hung on to CSL to be a 400 bagger, but I'd certainly like to interview them. We have another challenge, which is not to be underestimated in any way, and that's illustrated in this graph. COVID-19 has seen companies, some forced, like the financials, and some just through prudence, slash their dividends. And the need to employ new tactics and be very innovative, creative, delve further and wider to discover yield without taking risk, just not look at traditional areas. And that's become more necessary in this COVID climate. I mean, the graph there, the blue line shows how many companies in this 2020 period have reduced their dividend and how many have raised their dividend. And the red line is cutting dividends and the red's going the wrong way, where almost up to 70% of companies have actually reduced their dividends. And then the blue line is equally going the wrong way to round out the net zero at 1. So 30% of companies have raised their dividends, very few. And if we are just defaulting to the traditional, we're going to fail miserably. The stock I highlight there is one of the very few stocks that has not reduced its dividend and now has a 6.7% fully franked yield, is Horizon. And we've owned the stock for a long time. It's very well managed by Andrew Harding up here. And our journey in Horizon has had good and bad, to be fair. There was a period where they weren't allocating their capital well, but they have changed and now run a very conservative approach to expansion and payout ratios at 100%. They buy back their stock. Admittedly, at the moment, it's an on-market buyback, but it could well be a lucrative income fund off-market buyback over time. And the number is pretty impressive at 6.7% fully franked. But we don't believe you have to sacrifice capital to enjoy that yield. In fact, we believe that Horizon has some capital upside. So you need to look further and wider and with more creativity without the baggage of the past, but this does make it challenging. I'd quickly reassess that it challenges one only in the short term. We don't think this will be a dividend environment that will be enjoyed or struggled with for many years. In fact, 22, we think 21 will be very tough. 22 will come back quickly and 23 even further in a payout ratio sense. That's all I really wanted to talk about today. To summarise what I've said, and I have repeated myself a lot, so hopefully the message gets through. You're probably bored with me saying it already, but growth matters, and you don't have to choose. Yield without capital preservation is simply not an option, and you wouldn't need to go far in your client base to understand that. And we believe you can get both, but you can't get both by employing the old ways. They are no longer working, and the traditional yield sectors are value and dividend traps for ours. I'll just leave you there with the performance of the fund since inception, and we're happy to say that it has indeed achieved both of our twin goals. Thank you very much for your time. I hope you gained something from the presentation, and I hope you enjoy the rest of the summit.
Okay, David, I think we've got you online now. Can you hear us?
I can, Matt. And
okay. Over to you then.
Thank you very much for that kind invitation, Matt. And good morning, everybody. Terrific to be involved, to be honest. Almost a bit of escapism from the lockdown conditions here in Melbourne. Look, I think, as Matt said, we are, alternatives is very close to our heart. Here at Zenith, we are active users of both alternative strategies and alternative asset classes within portfolios, and always in search of, different funds, strategies, asset classes to include in portfolios, obviously with a view to, either improving returns, reducing risk, or, let's face it, hopefully both. I think as, a number of the speakers have already spoken about, we clearly live in very uncertain times, don't we? We've got a pandemic occurring that, none of us have lived through before, massive government and central bank stimulus. We don't know how all of that is going to play out. I think also, there is a view that, when we, and hopefully we do sooner rather than later, get a vaccine, that, everything will be good. Do we actually know that? From an investment market perspective, I think it was Paddy that already talked about, we've got a massive disconnect in at least a number of sectors that have been closed down by the pandemic, and the investment markets. Share markets have been booming, and yet from a economic growth perspective, things are looking pretty challenged at best going forward. And even if we find, or not if, when we find a vaccine, and as I said, the view that everything will be good on the back of that, may not actually be the case in playing out for investment markets, because we may get a rapid rebound where increases in interest rates may lead to increased bond yields and corrections in equity markets as a result. So I think, clearly we're in a very uncertain investment environment. And it is interesting that in our view and experience, that unfortunately, when that is the case, people tend to gravitate back or to things that they know and understand, rather than fully diversifying portfolios. And again, in our strong view and experience, in times like this of massive investment market uncertainty, you really do need a broad number of drivers of investment returns and diversification in portfolios, not less. And yet that's what we tend to experience in these periods of uncertainty. I think also Michael might have mentioned that we have high net worth investors, sovereign investors, sovereign fund investors like the Future Fund, institutional investors investing in a number of these alternative asset classes and strategies. And yet, and to be fair, we haven't always had the exposure to those within retail, but now we're getting that exposure. We're still not seeing, in our view, enough investment and diversification in portfolios through, what are sort of terrific strategies and asset classes. Part of that is clearly, and the feedback we get from advisors, is that they're not easily able to explain some of these strategies and or asset classes to clients. And so, I really commend Pinnacle on putting on a session like this. Clearly, as an industry, we can get much better than that. But we do need to provide our clients with more access to these alternative strategies and asset classes. So with that, there's plenty of questions for the panel, and I think I'll sort of throw the questions around to the different panel members to try and keep it dynamic and interesting. But given, Paddy, that you went first, I think you mentioned that whilst clearly the pandemic is not anything anybody's enjoying, it has resulted in much greater dispersion in stock returns and opportunities. So I guess a twofold question in relation to the short side. Are you seeing and do you anticipate a lot more opportunities for the short side of your market neutral strategy? And how do you manage risk on the short side? We obviously saw some, pretty dramatic falls in late February through March. How do you manage the risk of the short positions?
Sure. So I'll answer the first question first, which is about, in terms of volatility and increased stress in the market, are there more opportunities? As I mentioned in the presentation, more volatility will always lead to more opportunities, both on the long side, but most particularly on the short side. And we're seeing that, FY20, we had over 200 fundamental short opportunities. The previous year it was about 120. We don't short all of those, we only short 20 or 30. And looking forward, we still don't have a vaccine, there's still a lot of uncertainty. And at a point in time, government stimulus will need to roll off. So, there are companies that are surviving on JobKeeper. They can be potential short opportunities. You've got, retail companies that will be rolling off some pretty negative, or be replacing some pretty negative sales comps coming up. And then you've got banks and financials with heightened bad and doubtful debt. So FY21, we think there'll be a lot of opportunities there. Again, 200 plus we would expect. On the second part of the question, which how do you manage the shorts? You know, in a phrase, you know, very, very actively, but also very, very carefully. The hardest thing about the shorts is when, say, you're long a company, you're buying, say, A2 Milk, as an example, at $2 a share, the maximum you can lose is your capital, your $100 you've invested. But when you're shorting, say, A2 Milk at $2, the maximum you can make is that $100 if it goes to zero, but the maximum you can lose is potentially infinity. So where it is today at $14, you can actually lose 700%. So the first thing we look at with the shorts is the position size of our shorts are always at least half of what they would be in the long side. So a lot less risk there, and also the breadth of the shorts are much, much wider. But we also never short the fundamental and never short valuation, as I mentioned. We never short a particular theme, so we have a wide range of those. But the last thing we manage it is we always monitor them closely, but our maximum time frame that we're shorting a company for is 12 months. It is earnings, so trying to predict earnings downgrades over 12 months is really just a hope trade in our view. So we generally close the shorts out every 3 or 4 months. So turnover is much greater. And the reason for that is that if you short a company for a long period of time, you get an ever-increasing risk of a takeover, for example, which no one wants when you're shorting. So a lot of opportunities, and managing those shorts very, very actively and very, very carefully.
Thanks, Paddy. Look, that's probably a good segue, and the stock dispersion, and also to you, Sean, the slide you referred to about you can't rely on, you know, the banks for yield in the same way as we have in the past going forward. And you highlighted a couple of other large company stocks. Are you or are we going to have to throw the net further in terms of outside of the sort of larger companies into even sort of the mid cap, maybe small cap in that search for yield out of equities?
Yeah, thanks, David. I think we are, is the answer, yes. The main theme of what we're trying to preach, I suppose, is that exactly what you say, that if that is true and the traditional yield sectors are no longer able to anchor your portfolio, your income portfolio, one must be throw the net, as you say, far wider. But the catch, of course, is in doing so, one must manage the risk. And, you know, there's lots of mid caps and small caps that have that are not known for their payout ratios because they are rightly reinvesting their capital into their future. And we don't for a second begrudge that. But absolutely, there are some. And the biggest point we're trying to make is that you don't just assume that small caps are ineligible, that resources are ineligible, BHP being that example. That while the traditional yield sectors are no longer going to provide what you want, indeed, there are traditional sectors that are considered anything but yield candidates that will provide what you want. So we're not doomsday about it. We just think that you said cast the net, I said delve further. It's the same theme. One needs to remove the baggage of the past, completely open-minded, and just judge any stock for what it has in front of it in terms of both yield and capital. But above all else, one can't achieve the yield objective when you sacrifice the capital to do so. And that is what the traditional yield sectors, unfortunately, have provided, just that. They've given you the yield, but you've lost a lot of capital. So yeah, in short, I think we do need to cast the net further, but I'm not negative about it. I think those candidates are there. They just haven't been really looked at as closely in the past as they need to be now.
Yeah, agreed. To sort of change tack slightly now, Michael, found your presentation on the water fund and the water market really informative. Clearly, it is an asset class, as you said, that's been around forever, really, but not well known by the retail and advisory market. What are some of the fundamental drivers of water entitlement values, and how does that lead to sort of lower levels of correlation with the other major asset classes in your experience?
Yeah, thanks, David. In our view, 4 key drivers. So we've got annual demand from crops, so that's irrigators demanding water on an annual basis for long-term investments in their operations. We have the second driver, agricultural commodity prices. So this is demand from our trading partners, where we've had good competitive access over the years, and despite some current hiccups, we expect we'll continue to have good demand for Australian food and fibre. Thirdly, productivity gains. Australian farmers have been incentivised to deliver productivity and search for productivity, and that's meant their capacity to pay has increased as well. And finally, that supply of demand is limited and in fact reducing if you consider climate change, reducing the amount of inflows that we could expect. When you add all those together, you can see they're not correlated to your traditional investment classes. They're really focused on the Australian agricultural sector and the markets that it services, and hence we've seen those low correlations over the last decade or two of water markets.
Thanks, Michael. Gino, I thought you presented a really interesting slide in terms of the performance of global micro over the large cap indices. Or larger cap indices. In the Australian market, as we know, both the small cap and micro cap indices are full of, well, not full of, but have a lot of rubbish in them, to coin a technical term. And as a result, most managers are actually able to outperform the benchmark, most active managers. Is that also the case in the nature and makeup of the global microcap index? And is it a space in which active managers have a really strong record of outperforming?
Yeah, no, thanks for that question, Dave. It's a good question. I mean, yes, there is a lot of quote rubbish, but when you look at it, I mean, the sector allocation within micros is not too dissimilar to large caps. The only area where you're kind of missing out is consumer staples. You don't have, the big Heinz of the world and Mondelez of the world. But aside from that, I think it very much replicates the large cap space, except smaller. I mean, obviously, there's a lot of companies that are not yet profitable, not producing free cash flow. So, in terms of that, yes, there's less than in large caps, but certainly a sector split is similar. For us, though, I mean, it's really about cutting through the universe and looking for those sphere characteristics of cash flow, the returns, good industry structure. And so we can largely ignore the stocks, but because we do have 16,000 to choose from, we can set that bar very high. In terms of where there's a track record, I mean, that's the thing. I mean, not many fund managers offer a global market cap product. And of those that do, they haven't been around that long. It is a very niche specialist skill. I think the problem is often that, it's capacity constrained. You can't run, a big fund. So it really is the job of people who are passionate about smalls and micros to launch these products. We have to travel, we have to hire a team to do our own work. It is an expensive product to run. So in terms of track record, look, the signs are it is good, but there's really only 3 or 4 other managers around the world trying to tackle this. And that's what excites us about this product. It's very much undiscovered. Makes a lot of sense, but fewer on it yet.
You're right, it certainly does seem to make a lot of sense. I mean, how do you go about, as a small team, covering what must be, a massive universe? Do you use a filter process to identify stocks that you're interested in and do more research on, or how do you go about it with a small team?
Yeah, I mean, as I mentioned, we are very focused on the stocks we're after. I'm very proud of our screening. I think, we use multiple databases. There's 4,100 stocks in the index, 16,000 in the universe. So it's a lot of data. We have a data scientist to work through that. We can look at trends, not only static points in time, to really pick out those sphere characteristics in a stock. We also use machine learning to improve our screening, so we can feed back what we like and don't like into the algorithms and improve what the machine learning spits out. So I think our screening is very good, but ultimately it comes down to just being very focused. Our approach is quite different to your typical small and micro manager. A typical manager will say, we've met with 500-600 companies, we've kicked a lot of tires. That is not our approach. Our approach is to be laser focused on the sort of company we're after, do a lot of work on that company, so depth rather than breadth, and do it in a fashion that's very formulaic. And I'm quite proud of the fact that we also focus on things that I think small cap guys often gloss over. You know, reg risk, you know, currency, what are you short, what are you long, commodity risk, ESG risk. So the process is very encompassing, but it's quite disciplined, it's tight, and that means our analysts are very efficient. And the other thing I'd say is that, you know, as opposed to a local or regional manager, we don't really have to worry about stocks we don't own. You know, if you're a local manager, you do have to worry about stocks you don't own that are large in the index, because that can hurt your relative performance. Whereas our index is 4,100 stocks. The largest stock is 0.2% of the index. So we don't really have to keep an eye on anything we don't own. It's a much purer form of investing. So I think, you know, a combination of focus, I think combination of technology, really means we're covering it really comfortably and finding good stocks.
Paddy, if I could circle back to you, you know, one of the, obviously the promises, for want of a better term, of market neutral managers is exactly that they are, and the returns are neutral to that of the market, or neutral market exposure. You know, again, in our experience, at times various market neutral managers do demonstrate some beta to the market. How do you and your team and process guard against that and remain sort of true to label as a market neutral strategy?
Yeah, thanks for that. I've got to say our risk guru, Justin Gray, could write a book on how complex it is to manage net market exposure and beta through stressful or market stress times. But the key thing we do is we really want to understand where our risks are. And the key thing we want to do is push most of our risks into idiosyncratic risk or stock-specific risks. I mean, that's our bread and butter. That's what we're good at, not these thematic risks and the like. So we want to reduce those. But you are right, in times of increased stress, your beta can and does drift up, both positively and sometimes negatively as well. And that is the difficulty of a market neutral fund, is what's most important in times of stress, net market exposure or beta? Because through normal market times, you can get both pretty close to zero, or it's quite easy to get them to zero. But in stressful times, you've got to choose quite often between one versus the other. We always choose net market exposure of zero. And the reason we do that is through experience through the GFC and March 2020 of this year, where you get a number of correlation of 1 days where all stocks fall or all boats sink altogether.
Yeah.
If you've got net market exposure of zero and beta as close as you can to zero, you'll probably do okay. But if you've got net market exposure of, say, 50%, which most market neutral funds in Australia have, but observed or predicted beta at zero, when you get one of those correlation of 1 days, all boats sink, you will underperform. So through the month of March, a net market exposure of 50% when all boats sunk and the market was down 20%, almost certainly that manager would be down 10%. But you are right, betas will drift up, and it is a good risk metric, but it does have flaws. But it provides a lot of insight for scenario testing, if you like, which is what we utilised through the beginnings of COVID in February, where we created COVID betas for all our stock holdings plus all our portfolios to work out whether we're overexposed to an improving virus outcome or underexposed to that. And we found out very early on that we actually were the wrong way. We're effectively overexposed to an improving virus outcome, which clearly at the time was wrong. So our risk short algorithm quickly repaired that, left tail risk, if you like, to fix that. But through time, betas will go up and down, but market stress, generally they will drift up. You would have seen in our portfolio, we've had net market exposure zero all the way through, but we've had positive beta of 0.05, 0.06, or even 0.08. And that was mainly achieved through June and July, when we had a lot of recap opportunities and IPOs and the like, and most of them were in the mid-cap or the small-cap space. Generally, those companies have higher beta. Therefore, if we're going overweight those companies, we'll have slightly higher beta in the fund. Both are important. Net market exposure, in our view, are much more important through stressful times. Normal times, you can get beta to zero. Other times, as long as it's plus or minus 0.1, we're very comfortable with that level.
Yeah. Thanks, Paddy. Important feature and characteristic to understand of market neutral strategies and fire trails in particular. Michael, you talked to the demand for water by a number of the agricultural commodities, and clearly there's strong demand for all, or at least some of those agricultural commodities by China. Given the recent tensions with China, what impact is that likely to have, do you think, on the water market, the water asset class? And how exposed is the asset class to the fortunes and the political tensions in China?
Yeah, thanks, David. It is a relevant question. Australian agricultural commodities exported to China account for circa 30% of our total exports. So to say we're not exposed is unrealistic. I think what we like about the water market is it's a real diversifier. Now, to give you some examples of that, the current crops that are really impacted are beef and barley. So neither of those crops are irrigated crops. They're dryland or broadacre crops that really don't demand a lot of water. So to date, no impact on the water markets. The most recent crop that came into question is wine, and obviously the function of that is wine grapes. So there's an inquiry by the Chinese into exports of wine grapes, and that is an irrigated crop, and it's competitive for water as well. But to give you an example, we have deep and broad markets across our ag sector complex. So if I use citrus, for example, 15% of Australian citrus products are exported to mainland China. But behind that, we have 35 to 40 deep and broad markets that include Japan, Korea, Taiwan, Thailand, Middle East, all evolving and all growing at different rates and quite exciting rates as well. The beauty of water is it flows uphill to wherever that highest returning crop is. So if wine grape drops out of the complex, another one takes its place. So in short, yes, there's some exposure. I think when you look beyond the immediate headlines, being in water allows you to diversify across those markets and reduce that exposure quite substantially.
You also talked to, and had a chart actually, on the regulatory framework that water and water rights have operated in over time. Again, for the lack of those of us with lack of knowledge in the market, how heavily regulated is the market, and has that regulation been stable over time? Can we have confidence in government regulation of the water market?
Yes, I think in short you can have confidence. It took a long time to reach agreement across states and at a federal level to put the Murray-Darling Basin Plan in place. It's been tested through both political cycle, climatic cycle, ag booms, ag busts, bushfires, etc., and it hasn't wavered. We've had reviews from state governments to Productivity Commission to the most recent one, the ACCC review, and without a doubt, all of them have been broadly supportive and positive of the regulatory framework in place. Now, they've had sensible recommendations, which we agree with. We contribute to these reviews as well. And those recommendations are around data accessibility and visibility, so transparency. I think with any of these markets, there's a non-zero risk, but we really think the risk is really quite low. And I think underpinning that is the fact that 90% of the water entitlements on issue are actually owned by farmers. So any change to the regulatory system actually impacts more on the core constituents than it does on, say, financial investors such as ourselves.
Thanks, Michael. Sean, has the onset of the pandemic resulted in a material level of turnover in the portfolio? You sort of mentioned in your presentation the changing nature and also increase of companies cutting dividends. So do you see portfolio turnover, or have you experienced higher turnover, and do you expect higher turnover in stock names going forward?
Thanks, David. Yeah, yes, is the answer. And it was a pretty passive strategy, wasn't it, for decades? You just went along those couple of sectors and enjoyed the fact that the banks paid their divvies at a different time in the year to the most of the industrial and resource companies, and so you got two bites of the cherry, and that was it. You rotate into banks and rotate back and get a fantastic outcome. The answer is absolutely. You've got to be more. You've got to delve further and wider, and look harder for appropriate yield candidates, and that does require more turnover, and that does require a far more active strategy than has ever been the case. It's always been an area that has, I can't think of another area of the market that's had such a long period with the same tactic being so successful. But like all these things, when it turns dramatically. The first was the underperformance of the banks and Telstra. Well, not so much Telstra, that's probably been around for a while, but certainly the banks. And then secondly, to just follow it up aggressively in terms of the challenge, is that chart that you mentioned showing how many companies are cutting their divvies through COVID. But I'd say the first one, David, is a structural and permanent change. But the second one is more transient, I hope, we hope. Certainly down in Melbourne, I guarantee you hope. It will be, must be driving you completely bonkers to be in lockdown for so long. So, and we've got all your football teams up here, which is even better. So it's painful for everyone. I don't mean to be blithe, and it has definitely increased the challenge in the short term. I think that will normalise, payout ratios will return, boards will be less cautious, and indeed some of the impost is a regulatory one, APRA demanding that dividends be cut. But yeah, we need to be more, cast the net, as you said, further afield, and I think that plays into the hands of an income strategy that's anchored to a long only and long short portfolio that requires, the IP to be spread across the entire market rather than just a few focused sectors. But definitely turnover will go up, and I suppose with that requires risk management, because risk goes up as you delve down into a broader range of sectors and market caps. So yeah, it's much more challenging, I think, this space. That doesn't mean it's necessarily negative, but I think the spread of returns in income funds is going to remain very wide for a product suite that historically has had a pretty concentrated spread of returns across a survey, for example.
Yeah, no, that's a good observation. I certainly think that's going to be the truth going forward, and the weather behind you and Michael in Brisbane looks terrific, just to rub it in. Thanks very much for that. Gino, given I imagine that microcaps, global microcaps are, and maybe this isn't the right assumption, but are more leveraged to the economy, the domestic economy in which they operate in, is there a need for, in your analysis and process, an assessment of the macro environment for that country or economy that the company's operating in?
It's a hard question, David. I'd love a Dorothy Dixer at some point. But yeah, I mean, you'd be surprised how many of these small companies are multinational, global. They typically have a niche they're very strong in, and they sell that around the world. We do have some companies that are leveraged to an economy. So, for instance, one of our biggest holdings is, utility in Norway. Another one is predominantly Japanese with some export business. I think, one exposure we have a bit is Czech Republic and Poland. We have a UK company and a Finnish company that has some exposure there. So obviously we need to track how those economies do. It was pleasing to see they've handled COVID very well, though Czech Republic's had a bit of an issue of late. Hong Kong, I think, is a good example. We didn't own anything in Hong Kong. We just couldn't get comfortable on a name there. And then the riots were going very strong and hurting that economy badly. As they subsided, we hopped on a plane and went over there in September 19. Spoke to many companies, got a feel for what it meant, got a feel for the drop-off in Chinese visitation and the impact on companies, and came away comfortable to invest in a couple of companies we'd done work on. So for us, macro is more about risk. We're very much bottom up. We're not macro, we're not thematics. We're not going to turn around and go, oh, the German economy looks good, let's buy more in Germany. We don't do that. It's all bottom up, and the macro is really about managing risk. And as I said, I think in my presentation, we've got a nice spread of sectors, nice spread of countries, because you've gone down the market cap spectrum. I think the last thing investors want is for us to start punting on macro and thematics as well. We're going to stick to our knitting, and we think the alpha will come from that bottom-up analysis. So I think we have to be conscious of it, but I think you would be surprised how much of the portfolio has a global reach. I mean, MIPS, for example, which I spoke to in the presentation, I mean, they would hardly have any revenue from Sweden. That is a truly global business.
Yeah, you're part of your answer there in terms of the diversification across countries and sectors. And again, you pointed to the difference between domestic or Australian microcaps and international microcaps, but it does seem to be an asset class or sector that can provide some really spectacular returns, but also at times, probably equally spectacular volatility. What are you doing in your strategy to manage the volatility aspect?
Yeah, we don't employ any hedging strategies. It really comes back to that philosophy that's proven over many cycles that Spheria has, which is if you focus on strong balance sheets, valuation, free cash flow, that provides a floor. And so many of these companies don't have a floor. If it's all made up in revenue multiples, I mean, where is your floor? So we've found that through cycles, the Spheria process really comes to the fore. And March showed that. I mean, the performance, I think we performed in line with large caps. I mean, you're seeing moves of 20% in stocks like Tesla. I don't think large caps are quite as safe as they used to be because of all the passive money swishing around. You have to remember, passive doesn't come down into micro. So, look, it's nothing sexy. It's really about being sensible. It's about being valuation disciplined, being very conservative when it comes to leverage. I mentioned the portfolio is weighted average net cash. And by having a nice spread of country and sector, we think we're managing risk well. That drawdown was very pleasing because it validated our approach.
Paddy, you talked to the opportunities that the current sort of market environment presents from an active management and investment perspective. Do you envisage that creating more opportunities, in particular for the what you call the events aspect of your portfolio going forward?
Yeah, absolutely. They're obviously very prolific through COVID, but we think they'll continue for sure. At the end of the day, the events is really a relationship game between the fund manager, the equity capital markets group or the broker and company management. And we work those relationships hard. So we do get to see most recaps, IPOs and pre-IPOs. And as I said, there was 40 plus already. But we know with signing confidentiality agreements that there's at least another 10 to 15 coming through to the end of October as a minimum. But looking through to next year, we'll probably have a bit of a breakthrough December, January, Christmas, which you always do in terms of recapitalisations. But there's at least 40 companies in the ASX 200 that we think have too much debt. If we don't get a COVID vaccine, these companies will need to come to the market. You've also got high quality companies, buying out their lower quality competitors. That started already and will continue through to next year. And then the IPO and pre-IPO market will be prolific right through to next year because the access of capital in this market currently is very easy, and also the fairly rich valuations we've seen. Everyone talks about Afterpay as the one buy now, pay later, but there's been 5 IPOs or pre-IPOs in other versions of buy now, pay later in the last 4 months alone. So we think there's going to be an enormous amount of opportunity. And if we get a true COVID vaccine, the M&A market will heat up extraordinarily next year. So events will be very positive picking grounds, if you like, for the next 12 months at least.
Absolutely. A great time for active management. Thanks, Paddy. Michael, again, I think you had a terrific chart as part of your presentation, sort of highlighting the capital growth and income breakdown of water as an asset class. In your experience, can you give us some insight into how institutional investors allocate to water? Does it tend to be more in their growth allocation, or more so in their defensive? Have you got some comments and experience around that?
Yes, David. I think the key comment is there's no consistency across institutions that we've seen, and that's international and domestic. So the broadest group is alternatives, hence the sort of discussion today. We've seen it end up in real estate. We've seen it end up in real assets. Very few have a farmland bucket as such, or an agricultural bucket, some in natural resources. So it's really been a bit of a distraction actually to a lot of institutions. Where do we allocate this unique asset? And our argument has always been, we really don't mind. Look at the asset class on its fact that it delivers consistent yield, the fact that it's uncorrelated, and the fact that it's had a really good capital growth story as well. So it's BYO, pick your own effectively.
Anticipated that might have been the case. Look, we're bumping up against the time constraint now, so hopefully you've found that, I'm sure you found the sessions really useful, and the Q&A. So thanks to our panellists in Paddy, Michael, Sean and Gino, and I'll pass back now to Matt. Over to you, Matt.
Well, that brings our session today to a close. Please remember to click on the CPD Hours icon and complete the survey on your screen. Also, our last session is tomorrow. It's on fixed income with Metrics Credit and Coolabah Capital Investments. It should be a lively session with Christopher Joy and Andrew Lockhart. So thanks for joining us today. We hope you've enjoyed the program, and I hope you have a good day.